How do the Federal Reserve's interest rates shake up the stock market? Is it magic? Is it chaos? Or is it just Economics 101? Well, today, we're breaking it all down for you. Don't forget to smash that like button, hit subscribe, and let's dive in. Alright, first things first, what are these interest rates everyone keeps talking about? The Federal Reserve sets what's called the federal funds rate, basically the cost for banks to borrow money from each other overnight. Sounds boring? Trust me, it's not. Why should you care? Because this rate impacts everything, from your car loan to your mortgage, and yep, the stock market. Think of it like dropping a rock into water. The ripples hit everything. And guess what? Understanding this rock is the first step to knowing why the market freaks out or throws a party. Stay with me, this is where it gets good. So here's the big question. Why do these rates shake up stocks? It's all about the cost of borrowing money and investor psychology. When rates go up, borrowing becomes expensive. Businesses take fewer loans, grow slower, and their profits shrink. Investors see this and pull back on stocks. Boom, market drops. When rates go down, borrowing is cheap. Businesses expand, profits rise, and investors flood the market, pushing prices up. See where we're going with this? The Fed's decisions can either make stocks soar like eagles or dive like rocks. The market and the Fed are like frenemies. Best friends one day, enemies the next. When the economy's overheating, the Fed raises rates to cool things down. Good for inflation but bad for stocks. Investors panic. Oh no! Slow growth ahead. Sell-offs begin. But when the economy slows too much, the Fed cuts rates, making money flow freely. Suddenly, the market loves the Fed again. Cheap money? More growth? Let's go. Stocks rally. The bottom line? Every decision the Fed makes has winners and losers, and you need to know how to spot what's coming. But wait, this is where it gets even trickier. Not all stocks react the same way to rate changes. Growth stocks, like tech companies, hate higher rates. Why? Their future profits depend on borrowing cheap money. Value stocks, like banks or utilities, often hold up better because they rely less on loans. And bonds? They become the Fed's favorite child when rates go up. Investors shift money from risky stocks to safe bonds. Understanding this domino effect is key to navigating the market, so you don't get caught on the wrong side of a Fed decision. So, how can you stay ahead when the Fed makes a move? Here's the cheat sheet. 1. Watch the Fed meetings. They literally tell you their plans. 2. Keep an eye on inflation reports. They hint at where rates are heading. 3. Diversify your investments. Own a mix of growth, value, and bonds. And most importantly, don't panic. The market reacts emotionally, but smart investors stick to their strategy. To recap, the Federal Reserve's interest rate decisions impact everything: how businesses grow, how investors react, and ultimately, how the stock market performs. And remember that big question from earlier: what are interest rates, and why should you care? Well, now you know. They're the invisible hand that keeps the economy balanced, and sometimes tips it over. If you learned something new today, hit that like button, subscribe for more smart breakdowns, and let us know in the comments. Do you think the Fed will raise rates again soon? I'll see you in the next video.